Have you ever wondered how some investors seem to be perfectly positioned when the stock market takes off? The truth is, many of them don't wait for a bull market to begin. Instead, they prepare in advance by investing in assets that have the potential to benefit from long-term market growth. One of the simplest and most effective ways to do that is through exchange-traded funds, or ETFs. ETFs allow investors to own a basket of stocks in a single investment, providing diversification and reducing the risk of relying on just one company. In today's video, we'll reveal 5 ETFs that could be excellent additions to your portfolio before the next major bull run. Whether you're a beginner or an experienced investor, these funds offer exposure to some of the most promising areas of the market. Let's begin with the Vanguard S&P 500 ETF, better known by its ticker symbol VOO. This ETF tracks the S&P 500 index, which includes 500 of the largest and most successful companies in the United States. When you invest in VOO, you're gaining exposure to industry leaders like Apple, Microsoft, Amazon, Nvidia, and many other household names. One of the biggest advantages of VOO is its low expense ratio, meaning more of your money stays invested and working for you. Historically, the S&P 500 has delivered strong long-term returns and has been one of the most reliable ways to build wealth over time. If you're looking for a core investment that provides broad market exposure, VOO is often considered one of the best options available. The second ETF on our list is the Invesco QQQ Trust, commonly known as QQQ. This fund tracks the NASDAQ 100 index and focuses heavily on technology and innovation-driven companies. Some of its largest holdings include Microsoft, Nvidia, Apple, Meta Platforms, and Alphabet. Over the past decade, technology has been one of the biggest drivers of stock market gains. While QQQ tends to be more volatile than broader market ETFs, it also offers greater growth potential. For investors willing to accept a little more risk in exchange for higher upside opportunities, QQQ can be a powerful addition to a growth-focused portfolio. Coming in at number 3 is the Vanguard Growth ETF, or VUG. This ETF focuses specifically on growth stocks, companies expected to grow their revenues and earnings faster than the overall market. The fund has significant exposure to technology, communication services, and consumer discretionary sectors. Unlike dividend-focused investments, many companies in VUG reinvest their profits into expanding their businesses, developing new products, and capturing larger market shares. Our fourth ETF is the iShares Russell 2000 ETF, known by the ticker symbol IWM. This ETF takes a different approach by focusing on small-cap companies rather than large corporations. Small-cap stocks often receive less attention from investors, but they can deliver impressive returns during economic recoveries and early stages of bull markets. These companies typically have more room to grow compared to established giants. Rounding out our list is the Vanguard Information Technology ETF, or VGT. This ETF is designed specifically for investors who want concentrated exposure to the technology sector. It includes leading companies involved in software, semiconductors, hardware, cloud infrastructure, and other innovative technologies. Now, before you rush out and invest in any ETF, it's important to remember that every investment carries risk. Markets can be unpredictable in the short term, and even the best ETFs will experience periods of volatility. The biggest mistake many investors make is waiting until a bull market is already in full swing before they start investing. By then, much of the easy money has already been made. Instead, the key is to build positions gradually, stay disciplined, and focus on long-term goals. While no one knows exactly when the next bull run will begin, history shows that markets tend to reward patient investors who remain committed to their strategy. If you enjoyed this video and found it helpful, be sure to like, subscribe, and turn on notifications for more investing and personal finance content.